This is I just give a quick intro. This is my site, School of Valuation. I think some of you have already seen this. Some of you have already made purchases on the site. This I made the site exclusively for IBBI Valuation Exam. And it's basically a learning platform. You come to the site and you can discover courses. You can see all these financial reporting standards, case studies, valuation application part 1, valuation approaches, overview of valuation, macroeconomics. So very extensive course. Don't think that it is just some few MCQs. Literally the preparation is quite serious. If you take up any one course, I would think it takes about a week to thoroughly prepare, and there are tests in each course. So some of these courses, like valuation application part 1, I have made a database of almost 120 questions, of which the system will pick up 60 to 70 questions and throw it at you. You will have to take 4 tests of 20 questions each. So very extensive. I would think this goes clearly beyond what is expected in the examination. So the quality is much higher. So you'll be better prepared for the exam. Also, you have a blog here. Please do read these blogs. I think I've shared one of these blogs to you, and I think some of you have read and commented. Valuation of intangible assets. So generally, I try to write one piece on technical matter, which is within your syllabus, and one general piece as to how to write the exam, how to prepare for the exam. So for example, you can see valuation of intangible assets. I've also written about FIMDA and benchmarking in India. So nothing will be outside the syllabus. Okay, don't think these are general topics, good to read or something. These are all part of your IBBI syllabus. So if you go through evaluation application, you'll find FIMDA and the benchmarking and SLR, non-SLR bond, traded, non-traded, rated, non-rated bonds, how it's valued. So you have a lot of general topics are also there, like should I pursue this course after so and so, what is LibreOffice, and macroeconomics courses and all. So anyway, do feel free to go through these things. Some of these are interesting. There might be one article which is a general article, may not be relevant for your exams, like which is the best RVO and things like that. That is something for new students who haven't registered yet. Okay, the final thing is my account. Once you create this once you start taking your courses, you can see a chart in my account which will say where do you stand with respect to each course, what is your quiz rating, what are the topics that you have finished, and all. There will be a nice analytics. I have not logged in yet, so you'll get to see that also. It's a nice LMS thing. A lot of work has gone into it, so please do explore. Worth investing in this. So that is about LMS. I'll try and see if I can activate my Hi, I hope you are able to see me. So I think we have been only chatting through groups. We haven't seen each other. One day we should do a Zoom call where we all see each other. So I am Ashok. I am a CA, a CFA, and an RV. A registered valuation exam I finished only in October. I did it along with you guys in AI OVF. So one of the things I felt was there was there's a big lacuna in the way classes are conducted, and this whole approach towards the profession. Um, from day one, it is about clearing the exam without understanding concept. That's somehow faculties think that that's one very noble objective, noble aim, that I cleared the exam without understanding. And there are also I mean, sorry to start on a negative note, there are also faculties who have attempted 9 to 10 times the exam, and they also advise you how to write. So I felt at one we should set these things clear. We should have study materials which are really high quality, and our practice also should reflect that. Currently, if your foundation is not clear, then that will also reflect in your work. So I'm trying to bring sort of the best quality materials, which you can take for and will keep with you forever. So the School of Valuation materials, the standards are all, once you purchase it, I mean the courses, once you purchase it, it is always available for you. It's a one-time thing. Okay, so thanks for joining the thing. We'll quickly go to our topic. So I will move out. I will appear in this small window here. So I hope you can see me now. See me as in see the Excel file and me in the bottom right. Okay, visible. Just if you can give me a thumbs up, or just say okay. I think I got a message saying that can leave a message in the chat window. Okay, Anand San here. Okay, thank you, Anand. Okay, good. So I'm getting some thumbs up. I think I presume that everybody is able to see me. Okay, great. Okay, great. Okay, so see, the way I want to do it is I'll go through my Excel workbook, and I'll share this Excel workbook in the channel. I'll just put it as an attachment. You can download it later. Those who want to work along with me, you can also open your Excel file and at least do some calculations rather than just watching it. Okay, so I will try to do three topics. One is calculation of YTM, okay, and different variations in that. I'll try to do. There's a concept called dirty price and clean price. This form of YTM only, and there is forward rates. Okay, forward rates, spot rates is something which I find many people are not clear in these concepts. I've also evident from some of the questions that I posted, a lot of confusion in what is forward rate and what is a spot rate. Okay, so I'll try and cover these three topics. Okay, so YTM is a measure of a bond. It's a measure of return on a bond. Okay, it is similar to IRR, and we will just see some mechanics of calculation of YTM. So we'll just see the first illustration. Suppose a coupon rate of a bond is 4% and the payment is made once a year. If the time to maturity is 5 years and the market discount rate is 6%, what is the price of a bond? The par value of the bond is 100. Okay, so it's a simple plain vanilla bond. Its face value is 100. Maturity in years is 5. Coupon is 4%. Periodicity, as in how often the bond is paid, interest is paid on the bond, or the coupon is paid on the bond. And the market discount rate. Okay, market discount rate is another term for YTM, is 6%. Generally, when you see a problem, these 4 or 5 things, you can just write it down like this. It becomes much clearer. Okay. We'll see the cash flow table. So 5 years, and then these are the coupons. Better to put it as a formula. Lock it, put this dollar symbol and lock it, and then you can click and drag. You can copy and paste rather. See, be careful in the exam. For my convenience, I'm using Excel. Try to download this Office Liber or Open Office software. Okay, you will see how difficult it is. You will struggle to find where to put that dollar symbol. This dollar symbol is that absolute referencing. Struggle to find where this is, and a simple Control C and then Control V will not work in these softwares. Something else will work. It's some peculiarities or some differences are there. So I had my share of struggle with prepared for all the concepts, but didn't prepare for tackling Office Liber. So that's an issue. Okay, so that will kind of irritate you and it will consume your time and it will affect your concentration. So just download that and practice that thing. Okay, so you know how to do your discounting. You take this cash flow in the numerator, divide by 1 plus something. 1 plus something is the YTM. Okay, when you do this, just look at the periodicity. If it is annual, yes, you are right, you can do this. And then this hat symbol is power symbol to D15, that is the number of years. I think this is simple. Okay, and again you click and drag, you get your number. The last one, always remember to add the face value. Okay, don't forget to add the face value of the bond, and you do this discounting, sum all the cells. I think sum is a formula which works normally in all these softwares. It's similar, is equal to sum. At the same time, don't use shortcut. Sometimes, if you know, in Excel we use alt plus. Okay, alt and the plus or is equal to the one next to backspace. If you do this, it works in Excel, but it does not work in these other open office softwares. So that is the price. Okay, so the price, as you see, it's below the par value, and I think this you might know that when the YTM is greater than coupon, the bond will be below the par value. Okay, when the YTM, the discounting rate, is more than the coupon. That is because market discount rate means the market thinks that this particular bond should pay 6% coupon. That is the meaning. The bond, for the risk of this bond, ideally the coupon should have been 6%, but they are paying only 4%. So the market sort of brings down the face value to a rate which is commensurate with the risk. You can play around with this thing. For example, you can put 6% coupon. Okay, and so what you get is 66666, and what is the deficiency? The deficiency is 4 minus 6 minus 2. This is the deficiency. Okay, here it is just minus 2. Okay, this is what the bond is supposed to pay but is not paying. Okay, and the market doesn't like it. So you owe me 2 rupees per year additional. Now this 2 rupees thing, if you discount by 6%, this deficiency, if you discount by 6%, you do the same discounting, you will get this difference. That is, you will get this minus 100, 8.42. Okay, it's the basic mathematics. If you discount these values by 6%, you will get the shortfall, 100 minus 91.5, whatever that number was, 8.25 something. You will get that thing. It's just for your understanding. Okay, so So whenever you do these problems, when you read, keep all these checks in mind. It's a common sense test. You can use to eliminate choices also sometimes. If they are given 6% and they have given some bond values, and only one of them is below 100, you don't have to sit and calculate. You can directly go for that. So that's I think we'll see another illustration. Face value is 100, maturity 5, coupon 6%, periodicity is 6, the market discount rate is 6%. So it's simple. It's straight away, coupon and if yield is same, so the bond price should be 100. Okay. So this is a simple bond is trading at par. Okay, that's if the issuer has priced the bond correctly. That means he has come to the market and he's paying whatever the market demands. That bond will trade at par. Okay, let's see a third illustration. A 4-year 5% annual coupon bond is priced at 105 per 100 of par value. The yield to maturity is a solution for the data. Okay, so what I have given here is you have a bond 100, the price is given 105, the maturity is 4 years, periodicity is annual, coupon is 5%. You're supposed to find the YTM. You are supposed to find the discounting factor. Okay, so the way you would do this is, see, the bond is priced at 105. That means the price is more than the face value, which means the YTM should be lower than the coupon. Okay, price is more. That means the issuer is paying more interest rate than what the market is demanding. Okay, so the price is more than the face value. Now you need to find out what is the YTM. Okay, so you can use goal seek function. Again, goal seek is there in most of the softwares. It works pretty well. So what you can do is you can start with let's say 4%. It's not working here. 103.630. You need 105. So what you will do is go to data, go to what if analysis, go to goal seek, and you will set the target cell. What is the cell you want? This value should be a formula. Okay, this 103 should not be hard coded. You should make it as a sum of these values. What do you want? You want it to be 105 by changing what cell? What cell you want to change? Which cell? You want to change this cell. Okay, and you just click OK. 3.634. I'm sure some of you know this, some of you don't know. So for the benefit of those who don't know, see, this formula is linked here. This coupons are divided by the discount factor, that is 1 plus this thing. So that's how it's linked. So the moment this number changes, this number changes, and then you get this reference. Okay, so this is goal seek thing. If you are given the price, you can get your YTM. Set up the table. I mean, that's very important. Put all this data and set up this table, and you won't go wrong. Okay, so this is thing. I will share this file, and don't worry if you're not able to copy down everything. It's okay. Okay, this is a problem where we do with semi-annual compounding. Okay, suppose a Japanese institution owns a 3-year 2.5% semi-annual payment bond having a par value of 100 million. The bond currently is priced at JPY 98.175677 million, some huge amount. The yield per semi-annual period can be obtained by solving this equation. We can ignore the millions and just put the smaller numbers. Face value is 100, maturity is 3 years, coupon is 2.5%, but the periodicity is semi-annual. Okay, the coupon will always be expressed in annual terms only. Okay, even though it says 2.5% semi-annual, the semi-annual is the periodicity. The 2.5% is annual. Okay, that's the convention. Then the YTM is okay, this is what we are trying to find out. Okay, so and the bond is priced at 98.176. This is the full value. Just remove the million, and that's why you see it as a rounded off figure. Okay, see here, just be careful here. In examination conditions, we tend to not concentrate on these things. The way coupon is calculated is 2.5% by 2, so 1.25, and also semi-annual. So if the maturity is 3, it is multiplied by 2. Okay, so your table should have 6 columns. So 1.25, 1.25, and finally 1.25 plus this face value. Okay, don't forget to add the face value, common mistake. Okay, now now this YTM discounting, see this formula, it's D71, that is this coupon divided by 1 plus YTM divided by 2 to the power of this time period. So I have set it as an annual YTM. To convert it into a semi-annual discounting factor, it's very simple, you just have to divide by 2. Okay, okay, so that's how this formula is there. And again, it's the bond price is trading below par, so this rate has to be more than the annual YTM, has to be more than the coupon. So you start with 3%, it's not satisfying, it is not matching this bond price. So what you can do is go to goal seek. I want to set this value should be a formula to my target value, that is hard coded here, 98 point. Just for convenience, I'll just do 176 now. By changing cell, what do you want to change? The dependent cell, this cell should flow into this table. Okay, so 3%, 3.142. Okay, so do it one method. Okay, you take the annual YTM and you divide by 2. Sometimes if you are an expert, you can take semi-annual thing here and you don't need to divide by 2 here, but then the final answer choice should be multiplied by 2. Okay, so you will get if you don't divide here by 2, you will get a semi-annual YTM. How to convert a semi-annual YTM? Just multiply by 2, as simple as that, but do it consistently. If you take annual YTM, your discounted values, when you're discounting, it should have divide by 2, whatever divide by 2 or whatever periodicity is, you break up that yield and do the discounting. It's quite simple that way. Any doubts is there? You guys can put it in the chat. Or if everything's okay, I'll proceed. Okay. So things are clear, guys? Any doubts? Okay, all good. Okay, so the next concept that I wanted to introduce was spot rates. So see, this is a valuation technique for valuing bonds. You use something called as a spot rate. You do the discounting using spot rate and check whether the bond is overvalued or undervalued. Okay, so what are spot rates? Spot rates will be given in the problem. Okay, you just need to apply it. Spot rate is nothing but it's the YTM on zero coupon bonds. Okay, usually treasury bonds, which has no credit risk. It's the yield on a zero coupon bond. So, for example, if you have a zero coupon bond which matures in 6 months, basically there is no coupon. You get the principal value at the end of the 6 months. So, if that is trading in the market, and you can derive that YTM, and that gives you the cleanest figure of you can say it's a risk-free rate because it's a sovereign bond. So 6 months coupon you take like that. You take zero coupon bond which matures in 12 months, and you take its YTM, and you take a bond zero coupon bond which matures in 18 months. You take its YTM. So you have 6, 12, 18. Okay, so basically you have a discounting factor for a cash flow which comes to you in 6 months, or a cash flow which comes to you in 12 months or 18 months. But in reality, the people who provide us spot rates, like the benchmark company, Financial Benchmarks India Private Limited, I think we discussed that. So they are the ones who supply the spot rate, and they use mathematical techniques because you don't have zero coupon bonds maturing across the maturity time periods. So, for example, you may not have a zero coupon bond maturing in 18 months, but you may have a zero coupon bond maturing in 24 months. So, what do? You do something called bootstrapping. You can read up on it in Google. Not necessary for your exam. It's a mathematical technique of filling the gaps in the term structure. But the thing is, the spot rates. So what you should know is spot rate is derived from a zero coupon bond, which is a treasury bond, and it's cleanest form of it's the closest to getting us a risk-free rate because there's no credit risk and there are no cash flows in between. So what do you do with the zero spot rate? You have zero coupon bond YTMs on different maturity. So you take those rates, and you have now your bond, which is a corporate bond, which is a risky bond, which has coupons on so many dates: 6 months, 12 months, 18 months. So what you say is each of those coupon I will discount at a spot rate corresponding to that zero coupon YTM. So I have a bond which gives me regular interest, a corporate bond, let's say in 6 months. Now that 6th month cash flow I will discount using the 6-month YTM of the zero coupon. Okay, so each of my coupons I will equate it to the corresponding zero coupon YTM. Okay, and I'll discount it back. So the spot rates will be different. So at each position it could be different. 6-month spot rate will be different from a 12 months spot rate. Okay, so this is called discounting using a spot rate curve. Okay, so as long as you identify this, that it's asking for spot rate, because once you understand the spot rate, then we can explain what is a forward rate. Okay. Yeah. Okay, so what we have here is we have a face value of 100, we have a maturity of 3 years, coupon of 5%, the periodicity is annual. So this 1 year, 2 year, 3 year maturity, and you have corresponding spot rates, 2%, 3%, 4%. See, distinguish this with YTM. YTM was a single IRR rate which discounts across all cash flows. It's a disadvantage, okay, because it assumes that at each, find out what are the assumptions of YTM, you will have a better appreciation. It assumes that each of those cash flows are reinvested at a YTM rate, but interest keeps changing, the market interest rate keeps changing every day. So how can you assume that a coupon that I receive in 6 months will be further invested at today's YTM? Okay, it's a flaw. But if you hold the bond to maturity, you will realize the YTM. That's a different thing, provided the issuer pays you the full amount. So that's why when you see these numbers, you should be able to distinguish. Okay, I have been given spot rates. That means these are different rates across the term structure. So the same thing, you put your cash flows 5, and then the last year thing, last year face value redemption, and then look at this coupon divided by 1 plus the spot rate for year 1, spot rate for year 2, spot rate for year 3. See, remember this rate is an annual rate. Okay, it doesn't mean for 3 years the rate is 4%. It means that third year cash flow must be discounted at 4% per year every year to current. Okay, which is why we are using this exponent. Okay, which is why we're using this exponent. It's an annual rate. Okay, just remember that again, but that's because this is how you'll understand forward rates. Okay, so once you discount this, you will get a value. You can also derive, now that you've got this value, you can find out what is the YTM. Okay, and that's a different thing. It could be between these figures, it could be an average of these figures. You can do that as a curiosity exercise. What is the YTM and my spot rate is like this, 2, 3, 4. Okay, so good. I think we're going in good speed. So this is about spot rate. Now see, in all these calculations, we are assuming that we are 1 year away, as in you are assuming that 1 year from now the coupon is getting paid, 2 years from now the coupon is getting paid. But what if you are in between coupon dates? Okay, so that is so what happens is the seller of a bond will lose out on accrued interest between the previous coupon date and the current date, and the day or the settlement date, we call it. So the buyer, like the buyer will be on the record when the next coupon is paid. When the following coupon is paid, the buyer will be on record and he'll get the full coupon, full interest for that period. So what happens to the seller? He doesn't get, right? So when the seller invoices the buyer, he will tell, okay, this is the regular price, flat price, this is what it's been traded in the system, in the market, but I also need accrued interest for the portion period from starting from the previous coupon date to the settlement date or the trade date. So when you add that accrued interest to the price, which is called the clean price, you get what is called as a dirty price. Okay, so different terminologies are there. They say flat price or clean price, or full price or dirty price. Okay, so you have terms like flat price is equal to clean price. That is if you are doing like how we like the previous illustration, 1 year clear from 365 days from now you're getting the interest, and 2 years from now so that will be a flat price. Okay, and if you add the accrued interest, you get what is called as full price or dirty price. So this is the terminology. Okay, now in the market, in your NSE or whatever terminal, wherever trading terminal information is given, the trade prices are always in clean price terms. Okay, in the sense they don't account for the accrued interest. Okay, so it's essentially the trading price reflects the principal value. I mean, in the sense all the future cash flows, not principal value, all the future cash flows. Okay, it does not reflect the accrued interest. The reason is that if you add accrued interest, every day the bond will keep increasing in value. That's natural, right? Because every day there is accrued interest. The bond's price will keep increasing, and on the coupon date the bond price will suddenly reduce. Okay, so so that's an issue. So they don't want the trading system. We shouldn't for better investor information flow and all that. They don't. We don't include accrued interest in the normal trading prices. Accrued interest is always invoiced separately. Okay, so which is why we need to calculate accrued interest. Okay, so we'll quickly do one. We'll go through one illustration. So consider a 5% semi-annual coupon payment government bond that matures on 15th February 2028. Accrued interest on this bond uses actual day account convention. Coupon payments are made on 15th February and 15th August of each year. The bond is set to be priced for settlement on 14th May 2019. The annual yield to maturity is 4.8%. Okay, so you don't have to calculate YTM, it's already given. That corresponds to a market discount rate of 2. That's obviously understood, 2.4% semi-annual. Okay, so we have a bond. It's maturing on 2028, and you're given 3 dates basically. Coupon payment, that is 15th February and 15th August. That is with a gap of 6 months. And there is a trade happening on 14th May. Okay. So the guy who's selling on 14th May should get compensated for the accrued interest from the last day of coupon payment. That is 15th February is when he last received. From 15th February to 14th May, what happens to the interest? Ideally he should get the interest. He held the bond, so he will want compensation for that. So that we have to calculate. And then okay, we are given the YTM. Okay, so we can go ahead and calculate this. So I'll put the basic information again. Face value 100, coupon 5%, type is semi-annual, YTM is 4.8%, and the maturity. Okay, here are some important dates. Maturity date is 15th Feb to 2028. Settlement date, that is the trade date. Okay, the trade date is 14th May 2019, and the previous coupon payment date is 15th February, 14th May 2019. The previous coupon date is 15th February 2019. And the next coupon payment date is 15th August 2019. Okay, so these three dates you have to put down. It's critical for calculation. Okay, by the way, dirty price, clean price, etc. It's part of your IBBI syllabus. So that's why I'm doing this. Okay, so now we'll take the cash flow table. Now the thing is, at what point you should calculate the cash flows? You should take the next coupon date, the forthcoming coupon date, and then it's better to write put down all the dates. 15th August 2019. The next is 15th February 2019. 15th again August 2019. Once you have put 2-3 dates, you can click the fill handle and drag it. It comes correct. And just also have a check. So there are 18 periods. There is 9 years, twice a year. So 18 periods are there in this table. Cash flow 2.5. So why 2.5? Because it's semi-annual. The coupons are paid semi-annually. So which is why you take 5% and divide by 2. I think we are clear on that. And the last date you take the face value back. And you come back. What are you discounting? You're taking the annual YTM divide by 2 because the periodicity is 2. So you discount it by the annual YTM divided by 2. So you go all the way. This is understood. Then you take a summation of all those values. You get a discounted cash flow. Now the question is, what is this value? Where in a time scale, where is this value? This value is not on 15th August 2019. 15th August 2019, we discounted it back by one period, by 6 months. Our one period is 6 months. So we discounted it back from 15th August. That means we are on 15th February. That is the previous coupon date. This value is relevant for this date. Okay. So this is the price that we have got. Okay, this is not clean price, this is not dirty price. You still have to wait and watch what happens next. So this is just a price, discounted value on 15th February 2019, or you can say it's a theoretical price. We don't know if this was the trade price or anything. This is the theoretical price from our discounted cash flow table. Now what you have to do is you have to find out the days since last coupon. Okay, now the trade day is 14th May 2019. The last coupon date is 15th February 2019. So how many days are there? You can just do this cell minus this cell, 88 days. But here is where I want you to be a little cautious. Read the question carefully. It says accrued interest on this bond uses actual by actual day convention. If it says actual by actual day convention, that is the numerator is actual, divided by actual means the denominator. If the numerator is actual, what you've done is perfectly all right. Okay, but sometimes the day convention will state 30 by actual, so 30 by 360. Okay, 30 means every month in the calendar year has 30 days. Whether it is February or whether it's February, March, or July, August, or December, it is 30 days. So if it is 30, you have to do from 14th to 30th. How many days are there? You have to calculate 16 days. 16 plus from 15th February, how many days are there? 30 days, 15 days. In that month, 15. Next month, 30. March, then April 30, and then 4 plus 14. You have to do like that. Okay, we have not done it because in this problem it is just actual by actual. If they say 30 is the convention, every month has 30 days. Okay, now if you see FIMDAS regulations, in India the conventions are all It's all mixed depending on the instrument. They have separate conventions. RBI has a separate convention. SEBI says something. FIMDA says something. We don't have to. I mean, you don't have to research that. Money market instrument is something. Money market instrument might be actual. 30-year GSEC might follow 30 by 360 convention. So when it is denominator is 360, it means 6 months means 180 days. 6 months does not mean 181. 6 months means 180 days. Okay. Anyway, so for our convenience, we have taken actual by actual. So you have got this. This is simple for you. What will you do is, what you have to do is, you have to find the accrued interest. Okay. Accrued interest is simple. You take your coupon divided by 2, that is 2.5. 2.5, that is 2.5 multiplied by 88 by 181. A simple multiplication gives you accrued interest. Okay, you have this figure now. Just be careful. Your coupon is 2.5 for 6 months. In that 6 months of 181 days, it's only 88 days that you need to proportionately take. Okay, so don't take 5. 5 is for the full year. So you are taken 2.5. So you take, you take 2.5 multiplied by 88 by 181. Now, this is accrued interest. Next, you will come to dirty price. See, dirty price, there is a unique way of calculating. What you do is, you take this price, theoretical price that you received as of last 15th February. This theoretical price you take and you compound it. Okay, you compound it by so many days. By what rate? By some rate, right? That is the YTM rate. So D10. You compound it by the YTM. This YTM is as on the settlement date. Okay, this YTM is not as on 15th February previous coupon date. This YTM is as of settlement date. But it's like this. So this is what the convention is. You take the discounted price, you scale it, as in you compound it and bring it to today's settlement date. For that, you take the YTM as on the settlement date. Take a previous price, take today's YTM, you bring it, adjust it, and bring it forward to today. So you get a theoretical price adjusted for today's YTM for today. This is also theoretical price. This is called the dirty price. So you got accrued interest, you got dirty price. Your clean price is dirty price minus accrued interest. Okay. Okay, so is this okay? Again, I'll share these files. So any doubts, you can send a message. Okay, so no doubts. Okay, can I proceed to the next problem? Okay, then I'll just keep going forward. So we have similar problems, two more illustration, but if this is clear, I think I shouldn't spend too much time on the same concept. I want to explain about forward rates, and then we can wind up the session. Okay, so by team is clear. You understood what is spot rate. Now what is forward rate? Okay, this is where we have issues. Okay, so we are given some yields. Okay, basically these are spot rates. We are given spot rates for what time period? We have given spot rates for 1 year, 2 year, and 3 year. Okay, so the question is, how do you derive forward rates? Now, what is forward rate in the first place? Okay, so um, forward rate, the concept is derived from concept derived from derivatives or forward contracts. So basically, if you were to loan me money, not now, 1 year from now, for a 1 year duration, and we agree today that this will be the rate. So typical of a forward contract, right? I sell you something, I will sell you something in the future, 3 months down the line, but this is the rate. Today we have to agree on the rate. A forward rate is very similar to that. What is the rate or interest rate on a contract 1 year down the line for a 1 year maturity or a 2 year maturity? It doesn't matter, that maturity doesn't matter. What is the rate 1 year down the line for a 1 year maturity, 2 year down the line for a 1 year maturity? So essentially we are talking about the third year end. So if you're talking about 2 years from now, a 1 year contract, essentially that principal will be paid at the end of the third year. Okay, so forward rates are future rates, they are not today's rates. Okay, and it's speculative. It is, in the sense, you and I agree that this will be the rate, so agree that this is the rate for a future contract. And look at the naming convention. If you look at this cell 1y 1y, okay, see, this is not a standard convention. In some textbooks you find this, in some textbooks you don't find this. You might find some other convention. You might find something with F and then there'll be a subscript something. I find this as the easiest way of representing. The first, this 1y, this the first, this 1y represents the time into the future. Time going forward in future. 1 year from now, what is the 1 year rate? The second term, the second 1y is the tenor, you call it. Tenor means that duration of that contract. Okay, 1 year from now, what is the 1 year rate? Similarly, if you want to go down and see, 2 years from 2y, 1y means 2 years from now, what is the 1 year rate? Okay, so that 1 year applies from the second year to the third year. Second to third year, that contract you are agreeing today, the second to third year, we will enter into a contract. You give me money or I give you money, but this will be the interest rate. Okay, that is the forward market principle. This forward rate is derived from forward markets. Now the question is, for us, we are supposed to derive forward rates using spot rates. Okay, you're supposed to derive this. For example, you're saying 1 year there is a contract, there is a loan arrangement for 2.548%, and 2 years cumulatively 2.983%. So the question is, what will be the intermittent rate from that first year to the second year? There is a 1 year, no? That is the second year. The second year alone, what is the interest rate? That is forward rate. That's not visible here. We have to calculate. It's a break-even interest rate. No, you have always wondered, no? Like a 4-year FD in a public sector bank gives you so much rate, 8%. A 5-year FD gives you 9%. Okay, so between the, so shall I hold the 4-year FD, liquidate it, and then invest in a 1-year FD at that point of time in future, or shall I invest in a 5-year FD today? So you can do this break-even analysis. You can take this and see that rate chart, and you'll see that 4 to 5 year there is a break-even interest rate. Should you wait today, or you think that no, in that 4th and 5th year, that forward rate that the bank is offering, it's implicit in that contract, in the 5-year contract, is much higher than a 1-year rate 4 years down the line. If you think that's better, then you should remain locked in a 5-year FD. If you think that break-even interest rate offered by the bank is not good enough, they are underpricing it. I am sure that if I wait for 4 years, that 4th to 5th year, that the 5th year rate will be much higher. Then you can invest in a 4-year FD and liquidate and invest in a 5-year. Invest in a 1-year FD. So now we'll see 1 year from now, what is a 1-year forward rate? Okay, and before that, the spot rate in 1 year and the forward rate are always the same. Both are same, because today you are saying 1 year from now, this is the interest rate. In forward market also, you will say the same thing. 1 year from now, this is the interest rate. So spot rate, so if there is a forward rate here, the spot rate, first you can fill up this thing. The spot rate is the same. Okay. Now, how do you calculate the rate between these two dates? That is the first year ending, and then you take a 1-year contract. That means the second year, virtually the second year as a single year, what is the rate? So what you do is, you assume like, you can take one, this is basic compounding. I don't know how to, there's no better explanation than just looking at the numbers. So 1 plus this rate multiplied by A as in a missing figure is equal to the spot rate compounded for 2 years. So this is as good as saying I'll take 1 rupee, I'll invest at 2.548, which is available today, and I'll wait for 1 year and I'll invest at the 1-year forward rate. In an arbitrage free market, I should get my 2-year spot rate. Will I get? Okay, will I get or not is a different thing. Question is, we are calculating the break-even rate. So if you solve for A, you get basically you bring this down to the denominator, basic algebra, and annual rate you get is 1 minus this 3.5 for it. So that's it. That's your forward rate. Okay, so this is your 1 year rate 1 year from today. You see how this rate is different from 2.983. 2.983 is a spot rate for 2 years, okay, or the 2 year spot rate. But see that incremental return over this 1 year rate. This is the break even investment rate, or this is the forward rate. This is how you get this first figure. Now if you want to check with a bigger number, you just, okay, it's always easy to check with 100 rupees value. Okay, so you start with rupees 100, and end of 1 year you'll get these first year rate 2 point this thing, and you invest at forward rate. That one at the end of 1 year you get this money, right? So now I'm saying that this is the break-even rate. You invest at this rate, and now you get 106.05. Or you do the alternative. You invest 100 at the spot rate for 2 years. You get the same figure. So our 1 year forward rate is the right figure. Got it. So this is just for a check. Okay. Now we'll see what happens 2 years from now. What is the 1 year rate? 2 years from now, what is the 1 year rate? So what? Now this value 2 year. So you invest, so 1 rupee compounded for 2 years, and you have compounded for 1 more year. That's your missing figure. You will get a 1 year compounded for 3 years. I told you this 3 year spot rate is, always think of it as annual rate. So it's that rate is logged in today. Okay, so you compounded at 3 years. Now between 2 and 3 is our forward rate, that is the 1 year rate. So you solve it, again you get this annual rate 2 year, that is your 2 years from now. What is the 1 year rate? You can check again. Start with rupees 100, invest today at the 2 year spot rate. 100 into multiplied by 1 plus C7, that is this 2 year rate compounded for 2 years. Then you invest 1 more year at forward rate. 2 years from now, that 1 year forward rate, the same amount, this 106 that you matures in the second year, you're putting it in for 1 more year, 108.93. Instead, if you had invested at the spot rate, invested at the spot rate 100 multiplied by 1 plus C8, that is our spot rate 2.89 for 3 years. For 3 years, if you invest, you end up with the same figure. Okay. Now this calculation can be more complicated if you assume semi-annual compounding. Okay, so you can do that. It's in fact, this illustration I had made for semi-annual compounding, and then yesterday I thought that when you are introducing a new concept, as in a concept, I don't want to complicate it by semi-annual compounding, so I made this illustration with the annual compounding. Semi-annual compounding, you might find a small difference between this figure and this figure, because in semi-annual investing you're just multiplying the semi-annual YTM or spot rate by 2. So for compounding, when it compounds, there might be a small second level decimal place difference, but otherwise forward rates are derived like this. So what does it say? If the investor expects the 1 year rate in 2 years to be greater than 2.707%, the investor might prefer to buy the 2 year zero, that is a zero coupon bond, and reinvest the cash flow. It's natural, right? You have got the break-even rate as 2.7. That is the implied rate in this spot rate. The implied rate built in is that the 2 years from now, the implied forward rate is 2.7. If your reading of the economy is such that between 2 years from now, RBI will raise rates, therefore this compensation is not enough for me, then you wait, you invest only in a 2-year zero, let it mature. We will see what happens after 2 years. Maybe you get 3%, maybe your calculations are not working out. So this is what treasury people do. They're constantly worried about future trajectory of interest rates. Anyway, so this is the calculation part. So I think you're clear on this. Sometimes you will be asked to discount or value a bond purely using forward rates. Okay, not spot rates, purely using forward rates. The answer should be the same whether you are using spot rate or forward rate, because forward rates are derived from spot rates. Okay, so what changes only is the your formula, the compounding, the exponential formula, that only changes, and nothing else changes. This forward rate is not some new animal. It is just a derivation of your spot rate. That's what we have seen in the foregoing example. So I'll just quickly see this thing. It's a 4-year bond, 3.75% annual coupon payment that has the same risk. Yeah, that has the same risk as bonds used to. Okay, that means you derived this forward rate using some bonds. The question just clarifies saying that, look, you're going to value some other bond. Both these bonds are, it's good to value this with forward rate, because you have to adjust for the risk premium. So here we are not adjusting for any risk premium. That is fine. So what years to maturity is 4. I think just make it a number. Yeah, years to maturity is 4 years, 3.75% coupon. It's an annual coupon. So 3.75, 3.75, 100 and 3.75. You have got discounted values, but what are these discount? How are we arriving at these discounted values? We are supposed to take these forward rates. So I have a small table below. This is 0 years from now, that is today, 1 year forward rate. That is that I told you it's the same as a spot rate. 1 year from now, what is the 1 year forward rate? 2 years from now, what is the 1 year forward rate? Etc. etc. Basically, I've copied the problem, the data in the question itself. These are the rates. Now I need to put an equivalent spot rate during a period. Okay, so in spot rate terms, this is a 1 year rate. I need 1 year rate, 2 year rate, 3 year rate, and 4 year rates. Why? Because the cash flow table requires 4 values, so I will put these 4 values. Now I know my spot rate is same as forward rate only for the first year, so I'll take that. Now for the second year, what I need is a combination of these two. These two merges together to give me a spot rate. So I do 1 plus this rate multiplied by 1 plus this, that is a compounding. And then since it's an annual rate, I told you spot rate is an annual rate. So this exponent is 1 by 2. 0.5 is 1 by 2. And minus 1 to get the percentage. Similarly, my 3-year spot rate is a combination of 3 forward rates. Year 1, year 2, year 3. So I do the chain linked, complete this thing, or I can take this value, multiplied, compounded with this value and get this, whichever way. And I need to divide square root by 1 by 3, compounded by 1 by 3 to get the annual rate. So similarly, this the last thing. So I get spot rates for 4 spot rates. Now this can be used to divide, go into your cash flow table. So to the power of 1, then this cash flow divided by 1 plus spot rate raised to the power of 2, and if you take this cash flow, it is raised to the power of 3, and the last thing divided by 1 plus the last year's spot rate raised to the power of 4, and then I total this is your normal this thing table. So you get your discounted value, which is the theoretical bond price or the bond price assuming these forward rates. So so that's why you cannot straightforward use these forward rates for discounting, because these forward rates live in the future in between two time periods. Okay, so to bring it back to the present, you have to calculate the spot rates, or if you are very clever, you can directly do it here itself. 1 plus this rate, 1 plus this forward rate multiplied by the previous period's forward rate. You have to visualize it. Okay, when I discount it, it comes to 1 year, and then I have to bring it back, but that's a little error prone. Instead of that, you can finish your spot rates and come back and discount. Okay, that's about it I wanted to do. I think we have run more than the time. I think we had some technical issues in starting on the right channel, still learning that, and I think we started at 4:25, and we have taken 1 hour from then. That's it. I'm closing. If there are any doubts, please do ask me.